Great Portland Estate was founded by Basil Samuel in 1959 to invest in properties originally developed by the Dukes of Portland. It was first listed on the London Stock Exchange later that year and converted to REIT status in 2007. Great Portland's estate portfolio is entirely based in London, 82% focused on the West End, with the bulk held in office space. Great Portland Estate claim, because their strategy is clear, for example, they are not thinking about whether to invest in Edinburgh, Paris or Hong Kong, they get the best execution and read the cycle. London itself is an unusual city in many ways, not least because the bulk of its most expensive leasehold property is owned by just a handful of families. Historically, the four biggest landowners are Grosvenor, Cadogan, Howard of Walden and the Portman Estates. Real estate investment trusts such as Land Securities, British Land and Great Portland Estate have muscled in on the action over recent years, along with foreign investment, which in itself now accounts for approximately 10% of all property ownership in Westminster. Property companies have made significant gains in recent times. Moreover, REITs, which invest almost entirely in commercial property, continue to be a popular investment, with many REITs routinely yielding well above 5%. Real assets, such as property, are also traditionally seen as a good hedge against rising prices. The question is, will REITs' overperformance continue? Fundamental to Great Portland Estate's continued success is a continuation of London's economic prosperity. Despite greater economic uncertainty since the start of 2016, the employment intention of London's businesses remain expansionary and their space needs continue to follow suit. Vacancy rates are now at record lows in the West End, and with anticipated further increases in rents, demand for prime properties remains robust. In the context of these supportive market conditions, Great Portland Estates expect to continue delivering significant growth. London has more than 230 million square feet of office and retail property. With its 3.6 million square feet portfolio, Great Portland Estate's market share is less than 2%, giving it ample scope to grow. Great Portland Estates owns $3.2 billion of real estate, maintains a strong balance sheet and a conservative financial leverage, with a low-cost diversified debt book. Such a conservative position, coupled with a diverse debt portfolio, helps to provide protection against the cyclical nature of the company's core property market and maintain the business's financial flexibility when new investment opportunities arise. The majority of Great Portland Estate's portfolio is centred in and around Fitzrovia, a district in central London best known these days for being the location of the 1,777 metre high BT Tower. Completed in 1964, it was the highest construction in London until 1980. Near London's West End, Fitzrovia is situated between Bloomsbury and Marylebone and north of Soho. It is characterised by its mixed use of residential, business, retail, education and healthcare, with no single activity dominating. The historically bohemian area was once home to such writers as Virginia Woolf and George Bernard Shaw. Although often described as an upmarket area of inner London, Fitzrovia has wide disparities of wealth and contains a mix of affluent property owners, as well as many private, council and housing association tenants. The neighbourhood is classified as above averagely deprived, and parts of it have the worst living environment in the country. Conversely, in March of this year, the Sunday Times named the district as the best place to live in London. Because Great Portland Estate went into the 2008 crash in a relatively strong position, the business was able to exploit opportunities that emerged. Since the summer of 2009, they have bought just under 60% of the portfolio they own today, with the bulk held in office space. Historically, whilst no real estate company had a great downturn, GPE read the cycle better than many others. In the 2 years leading up to Lehman Brothers' demise, GPE were a net seller. They reduced their development exposure to the point that when Lehman went down, they had less than 10 million of future capital commitments, but also maintained financial leverage at relatively low levels. At that point, GPE's loan-to-value was considered the lowest of any listed property company in Western Europe. With a reversionary potential of 32% and plentiful low-cost financing, GPE's fundamentals would appear to suggest they are strongly positioned. REITs have generally done well over the past 5 years as the real estate market in the UK emerged from the 2008 crisis and took off. Now there appears to be a levelling off and even a decline. The gains these trusts have seen may become a thing of the past. Earlier this year, Chancellor of the Exchequer George Osborne warned of risks to the UK from the shaky global economy, in particular continued volatility in the Eurozone and a 7% drop in the Chinese stock market on the back of a shrinking economic outlook. Whilst markets are currently blasé about the impact of the UK's potential exit from the European Union, there is an obvious concern a vote to leave would lead to further market uncertainty. With the UK's domestic economic outlook remaining uncertain, this could have implications for tenant demand and rental yield growth. The ongoing difficulties facing many leading retailers are a high-profile example. However, due to its focus on the office sector, which makes up 71% of its portfolio, GPE is not as exposed as some other REITs to turbulence in the retail sector. That said, banking and finance make up approximately 1/4 of Great Portland Estate's office portfolio, which could be a potential concern should the economic climate continue to decline. Aside from profitability, any business's reputation is very much driven by a company's leadership. A quick analysis of the makeup of the GPE board would indicate a predominantly white, middle-aged and male group. Whilst for some this may add to GPE's reputation of being a solid, traditional and well-run business, others, including psychologists Kahneman and Tversky, argue that something known as cognitive bias has implications for, amongst other things, finance management. The notion of cognitive bias refers to a systematic pattern of deviation from norm or rationality in judgment, whereby inferences about other people and situations may be drawn in an illogical fashion. This theory follows on from Keynes' thoughts on human irrationality. Keynes subscribes to the notion that businesses make production decisions not based on sales or anything measurable, but on personal opinions and expectations. By extension, therefore, a predominantly white, middle-aged and male group could potentially result in faulty decision-making and a deterioration of mental efficiency. This is especially so when a group's members are similar in background, highly cohesive, and under pressure to make quality decisions. This is similarly reinforced by the demographics of the company's employees. Nearly half of the employees are aged over 40, with just 12 in the 19 to 30 age group. An organisation with a diverse range of employees is well placed to understand the needs of a wide range of customers and can interact with a broad client base. Not only that, but it is also in a good position to recruit and retain staff in an increasingly diverse and competitive labour market. Potential employees want to know that employers treat their staff fairly regardless of race, ethnicity or gender. Not only are such firms able to attract new talent, but they can also retain existing talent because of high employee morale resulting from workforce diversity. Talent is no longer represented by a homogeneous group, but one representing people from many different backgrounds and life experiences. Embedding diversity of thought throughout an organisation also means that talent can be properly recognised and nurtured. Employees from different backgrounds bring in a variety of solutions on how to achieve a common goal. As more diverse ideas are suggested, the chances of finding a workable answer are often improved. On a more practical level, companies that operate in global markets benefit from language diversity in the workplace, as well as a predominantly older workforce, particularly at senior levels, having implications for succession management in the near future. Most global markets are at or close to historic low yield levels. Great Portland Estate's historic 5-year share price analysis demonstrates a consistent period of growth and would make it a poor investment based on Buffett's philosophy of the greater the discount, the more room for profitability. Whilst the consensus appears to be Great Portland Estate will continue to outperform the market based on good fundamentals, a consistently strong balance sheet and conservative financial leverage, at $7.23 per share and falling from a high of $800 at the start of 2016, once again the question is it actually trading below where it should be? As a rule, during 2015, property stocks performed spectacularly in the UK, with the sector up by 7.5% compared with a fall in the central London property FTSE 350 of 4.8%. Returns were strongest at the start of 2015, but slowed as the year went on. With the market now arguably towards the end of the cycle, the year ahead is unclear. Since the start of 2016, it appears London may be on the verge of another property crash, making GPE strength its greatest weakness. It pays to diversify in a volatile market. Commercial property development and rent levels are historically high when the city booms. While there is no suggestion London will experience a big short like 2008, GPE is currently trading at $7.23 per share compared to a high of $8.49, equating to a 15% fall with a swing of 5% over the last month alone, demonstrating some degree of volatility in the market. More worryingly for the potential investor, the slide in Great Portland Estate's share price would appear to mirror a general slump in the stock market over the course of the last 12 months. However, the company's relative success over the period, when it was trading at a level some 10% above the market, has now seen a greater crash, with the market now outperforming Great Portland Estate. More generally, there is an argument that there is clearly some disconnect between economic performance and stock market buoyancy over recent years. Any renewal of Euroland instability and upsurge in activities in the Gulf, or even the wrong result in the US elections, may bring a threat to unstable markets. More specifically, the London property market is increasingly recognised as a bubble, and the bubble may burst. Valuations are high relative to history, falling interest rates cannot provide further support, and London's property boom is unlikely to endure. Now may be a good time to reduce exposure to overvalued property markets, and not just in London, but in cities such as New York, Hong Kong, and Singapore, and to diversify. For investors who feel uncomfortable with single stock investments in REITs, one alternative is an investment trust specialising in property, of which there are more than 20. These trusts also hold diversified portfolios of property, as well as property company shares in certain cases, but have generally been run much less aggressively than REITs, with managers operating buy and hold strategies. This approach protected investors during the credit crunch and the peak of the Eurozone crisis, with property funds avoiding the extreme volatility seen in the REIT sector and largely maintaining their dividends throughout. Of the sector's two largest trusts, F&C Commercial Property and UK Commercial Property, the former has the better track record, partly owing to the latter's historical portfolio bias towards the retail sector, although both are in positive territory over the medium term. In summary, rather than invest in GPE, there is an argument to sell quick and buy into something safe, such as gold or even oil. BP shares have fallen circa 30% in less than 2 years, but crude oil prices are now stabilising and offer good prospects for long-term growth. Otherwise, with economic uncertainty and political unrest, it pays to invest across different countries and markets. For the cautious investor keen to avoid losing their capital, it would be prudent to see what the market does during 2016 before investing in REITs. Whilst Great Portland Estate is still at a premium to net asset value, the company's dividend payments aren't great. Whatever the investor's objectives, there is no escaping one fundamental flaw in both the technical and fundamentalist method of forecasting, scuttlebutt, or any other economic analysis that may come to mind. A flaw underlined by the 2008 financial crisis, predicting the future. The hard truth is no economic forecast can be truly accurate, and almost certainly most will be wrong. Some may be accurate and even hit the target, but no one can say with absolute certainty which will fall into that category. However, whilst investment decisions are made in a world of uncertainty and making investment mistakes is expected, making a mistake based simply on poor investment advice is another matter. Bad advice has its own consequences for the client in the short term, but in the long term the consequences may be even more dire for the advisor, dependent on who their client is and their reaction to losing all their hard-earned money.